Hey everyone, happy Thursday, August 10th. It's about 11:40 on the West Coast, and it's time for another market update. Another busy week as usual. Going back to last Friday, we got the big July BLS jobs report. This is very important because the Fed is paying very close attention to jobs right now, and it missed expectations. It was expected to add 200,000 jobs. 187,000 jobs were only added, and there were some negative revisions to May and June, which I mentioned before is a little annoying. You know, they come out with these big numbers, the markets get hit hard because these job numbers are so big, and then a couple months later they say, never mind, we were wrong, but we don't get the bump from that. So some negative revisions. Like I said, only 187 versus 200,000 estimate created. The birth death model is showing 280,000 jobs created, which again, this is measuring how many jobs are created from new businesses and how many jobs are lost by old businesses closing. And right now it's showing plus 280,000, which is bigger than the whole job created overall. And that seems a little weird with the current economic environment that so many jobs are being created and so many people are starting new businesses. The next thing that was a little weird is leisure and hospitality came in at 17,000 in the BLS versus 201,000 this month a couple days ago in the ADP. And the last 2 months combined, 36,000 jobs created in the BLS in that sector, 433,000 in the ADP. That's a huge discrepancy. Another thing, something to note here, is that the average weekly hours declined from 34.4 to 34.3. That doesn't sound like a huge deal, 0.1 hours per week. But if you exploit that out throughout the whole labor force, that's the equivalent of losing 312,000 jobs. Again, wipes out this 187, and we're negative 125. So again, it doesn't seem like a big deal, but that's just that 0.1, and this number keeps going down. That's a sign of a weakening job market. Another thing to keep in mind with this household survey. So the big thing we came out from this unemployment stuff was 3.6. The unemployment rate dropped from 3.6 to 3.5. However, if you look, full-time jobs dropped by 585,000. The part-time dropped or added 972,000. And then look at this, 55 and older, 392,000. So if people can't find full-time work, they can only find part-time work. Multiple jobs went up, I believe, 118,000 part-time, or I'm sorry, yeah, multiple jobs, having two jobs or more, and then 55 and older, 392. So all those things, having multiple jobs, not finding full-time work, and having to go back to work if you're 55 and older, do not indicate a very strong job market. In fact, probably the opposite. The next thing we got this week was actually today, July CPI. In big inflation data, it actually missed expectation. It was supposed to come in at plus 0.3, came in at plus 0.2 month over month. Year over year, however, crept from 3.0 to 3.2. And the reason for that is how year over year stuff is calculated. Last July, it was a really low number, slightly negative, in fact. So if by going up by 0.2 this time, it's going to affect the year over year and go up to 3.2. Core dropped a little bit, which was above expectation. It was supposed to stay at 4.8. We got a little bit of a bump like we thought about from shelter, which is such a huge part of that, and we'll get a little bit more into it. Used cars started to help us, which had been hurting us in the past. But the things that economists kind of thought were going to hurt us, and something to keep an eye on for August, is gasoline and food. These were supposed to come in higher. They didn't. Does that mean that they're not going to come in higher, or does that mean they're going to come in higher later, meaning August? So that's something that we're going to have to keep an eye on. But overall, not the worst inflation numbers today. The next thing we got was initial job claims today. So those were supposed to be at 230,000, and they came in at 248,000. So those have been dropping, but now tick back up. So again, maybe this is a sign of the labor market starting to weaken, like we're kind of seeing. Again, this is very important because the Fed is paying very close attention to that. We don't want people to lose their jobs, but again, Fed seems to. Purchase apps were down 3% week over week, 27% year over year. Continues not to be good in the mortgage industry on that side of things. Miscellaneous stuff. So here's some important stuff. So appreciation again jumped up. Black Knight reported at 0.7% for their survey. So now all these yellow ones are all-time high readings. We haven't got Case-Shiller FHFA yet, but they seem to be on the same pace. You're seeing these 2023 paces of 10 to 5%. So all these people that tried to wait to buy, houses are more expensive now. And Black Knight also reported, I believe, that the average amount of equity that people have is 199,000, which is a lot different than pre-housing crash 2006, 2007. Also, we got credit card debt. Congratulations, America. We're over $1 million in consumer credit card debt. That is a lot of consumer credit card debt. That is not a sign of a strong economy. That's a sign of people haven't used their credit cards too much. But you pair that with all this equity and appreciation that does line people up. If even taking a higher mortgage rate, you could pay off a lot of that consumer credit card debt using the equity in your home and come out at the end with lower monthly payments overall because you're eliminating other debts like your car payment, all these credit card payments, things like that. And then also we got some Fed talk and projections. Really the main ones I wanted to point out is that the Fed, besides the fact that the Cleveland Fed is saying, hey, we got to be on the lookout for this gas and food stuff. But the San Francisco Fed started beating the drum. They came out with these numbers about shelter inflation, and like we've been talking about, and MBS Highway has been talking about, shelter inflation is lagging quite a bit. These inflation numbers are showing a lot higher than it is. If you look at the real-time metrics like apartment list, things like that, it's showing it dropping a lot faster, and the San Francisco Fed is showing that as well now. So this is their forecast. It continuing to drop. We know we have favorable numbers comparing it in these inflation numbers until next March, I believe. So we should continue to see this drop, but we got to hope that it overrides any increase we get in gas prices and food prices and things like that. But it's good to see that the San Francisco Fed has caught on. Let's hope that the voting members and everybody that's making these decisions on rate hikes has caught on as well. The next thing we got, average rate is about 7.10 right now. It was down from 7.2, still way too high. We've been hanging on in these high sixes, low sevens for quite a while. The highest we've been was 7.37. The lowest we've been in the last, 6 months to a year, I think is 5.99. I wish we can get down in the low sixes again, but it's going to be some tough sledding here for a bit. And then where does that lead us? Tomorrow, actually, we get PPI, producer inflation. That should come in pretty good. They've been really low lately, so be on the lookout for any negative remarks based on just slight increases, considering last month was really low. Then we get PCE, BLS, another CPI, and then before the Fed meeting on September 20th, the Fed is, right now, the markets are expecting there's a 90% chance they don't hike and 10% chance that they hike again. We don't want them to hike. So let's hope for the markets are right and that 90% holds. But like I said before, right now rates are really high, but if you can afford the payment, you should still jump on it. If you're a borrower, if you're an agent, you got to tell your clients that, show them how much money they've missed out on appreciation just over the last year. If there's somebody you talk to and they were going to wait a year, the amount of money they would have spent on having a higher rate and a higher payment is dwarfed by the amount of money they would have made in appreciation. So that's something to keep in mind. If you guys need anything at all, please don't hesitate to reach out. Otherwise, have a great week. Thanks a lot.